Welcome to the Investor Agent Podcast. I'm Steve Seymour, your host, where we help transform the human mindset from scarcity and lack to abundance and wealth, one conversation at a time. I'm Steve Seymour here with the Investor Agent Podcast. Today, our guest is Chris LaSpada. Chris, thanks for being on today.
Steve, thanks for having me. I was honored you asked.
Yeah. So, Chris, tell us a little bit about your background in real estate and accounting.
Sure.
Taxes.
Sure. So I started in private accounting, very quickly got into public accounting. And what I liked about public accounting was working with any type of business owner, didn't matter what. But probably about 10 years ago, we really started to focus on real estate, through a different connections that we made. And we started doing a lot with real estate clients. That's kind of how we met, through a mutual connection. So a lot of our business now is focused on clients that have real estate, whether they are owning a operating business, but they own the property, whether they're investors in syndications, whether they're multifamily, single family. And a lot of what we're doing now is not just doing the tax returns, because that is a necessity, but other advice, other consultation, and everything. I'll give you an example of something, depreciation. Everybody kind of hears the term bonus depreciation and they want to talk about the benefits of that. And we talk about cash flow and taxes. And so we're pretty busy with our real estate investors talking about all those topics.
Yeah, focusing more on strategy.
Right, because
tax strategy. You don't want to be just bookkeeping and accounting.
Well, you don't want to be the person that just says, "Hey, what do I owe? What am I getting back each year?" You need to be thinking forward, like, okay, if I do this deal, and for example, should I get a cost segregation on the building? What's that going to cost me? What's that going to save me? Am I looking to pay less tax now and kind of kick the can down the road? The dollar's worth more today than it is tomorrow, so. And the more money I can save from the government, now I have more money that I can keep investing, and just keep investing. And, that's a lot of what we're trying to talk to people about, because it's just not doing the one deal. It's kind of thinking ahead. It's not always about, should I buy or sell this building? What's the tax ramification? Yes, that's a lot of it, but you got to think forward and you got to think ahead as to why, what's the future implication of that? Not just what you currently have, but what's going to happen in the future, and should I have made this decision or not?
Sure. Yeah. What would you say? I kind of like to start off with like some big mistakes that you see that people make. Like, what do you think are some of the biggest mistakes that real estate agents or real estate investors make in terms of leaving a lot of money on the table?
I would say, let's start with the agents. Because typically agents are, let's say they're self-employed individuals, and not to go crazy with Schedule C and some of the self-employment tax, but sometimes with agents, it's a matter of, which is the right entity for them. So for example, if you're an agent and you're just like a single member LLC or just in yourself, and there's self-employment tax implications. However, maybe you should have formed an S Corp, and maybe we need to, because what we're trying to do is we're trying to save money on self-employment tax. And the other thing with agents, it's they're not on top of paying their taxes on a quarterly basis. And what they're doing is they're getting to the end of the year, and then with cash flow, and sometimes the market's great and you're selling all the time, and sometimes it's not. So then you start incurring interest and penalties and payment plans, and you're kind of always falling behind.
Yeah.
The other thing is thinking of retirement. Yes, it's a tax savings. However, agents are more one man, one woman operations where they don't have employees most of the time. So they can get very aggressive with their retirement planning. And sometimes I think when they're not, thinking of these things or working with the right person, that they're just missing out on this stuff. And then when they do find that person, then they're just playing catch up for the first couple of years.
So they're not using their qualified plans,
right?
They're utilizing different options.
Especially when you're one person plan, the options of how you invest that money is a lot greater because you don't have employees to worry about. When you're an employee employer with multiple employees, there's only certain types of plans you can offer.
Yeah.
I mean, you can't do the whole, as you know, self-directed IRAs and self-directed retirement plans, because you can't just offer them because you have employees. So sometimes you could think about, everyone thinks retirement plan, I have to invest in the market, I have to invest in that. And it's like, that's not necessarily correct.
Gotcha. Yeah, that's big. So, I hear a lot in that. What about, can we talk a little bit about the real estate professional election? Is it,
Sure.
Is it 469 in the tax code?
469C. Yeah. So it's a very interesting one because it comes up a lot. And, unfortunately or fortunately, having been through one of those audits with a client, you kind of get an idea of what the IRS, what documentation they're looking for. And yes, they're looking for a log with the proper amount of hours to be considered a real estate professional. And there are certain hours that they don't particularly care for when they're looking at these logs, like bookkeeping.
Let's start with at a high level.
Yeah.
Though. What is the real estate professional election? What is the benefits?
Right. So the benefit of the real estate professional election is you're not limited by the passive loss rules. So what happens is, under normal circumstances, if your income's $100,000 and you have $50,000 in rental losses, you can only take $25,000 in that year. If you're considered a real estate professional, the losses are not capped. So it's a very important thing when, especially with a married couple where maybe one person's W-2 and the other one's a real estate professional, and now they're able to take all those losses against the ordinary income. So it becomes very powerful.
Yeah. Obviously
it's a very big hot button because, how do you qualify? And it's basically 750 hours and
so that's 750 hours per year.
But those hours, you can't have another activity that exceeds that. So you can't say, oh, I'm a 2,080 hour W-2 employee and I did 750 in real estate.
Right.
I'm a real estate professional. It's like, no, your real estate professional hours
you have to actually meet the requirement.
Right. You have to meet that requirement.
You're a real estate professional.
And the second thing that I think kind of gets glossed over is, especially when you have properties, is the whole material participation, and again, it's just one of those things that, we probably wouldn't dive deeply into here, but it's one of those things. It's kind of like, I always kind of consider it A and B, like, okay, are you a real estate professional first? And then let's talk about the material participation rules.
And is it 500 of the 750 hours you have to materially participate?
Right. And then there's different ways you can materially participate, but again, it's something you have to think about, and because sometimes you could group activities to get to the 500 hours or 100 hours per property, just giving you some examples. So it's one of those things that, you can't just think of one way without thinking of it the other way. Because if you do, I've seen where the IRS is like, great, we agree, you're a real estate professional. However, we don't think you materially participated. So then it's kind of like all that work and all that effort and strategies out the window.
What are the things that they clearly, agree upon that is material participation?
Usually managing the own property. Managing the property, reviewing leases, negotiating with contractors.
Is managing contractors? Is that?
Yeah, that's a big one. Okay. Inspection, leases, like those are the things they like to see. Not everybody's going to pick up the hammer and do the work. I get that. I'm probably the one that least could do that myself, but that's the part where that's what they want to see. They want to see either that you're working, when you're working in the property and doing the work yourself, it's easy. But when you have contractors, you're managing that, you're doing all that stuff. What they don't want to see is, bank deposits and bookkeeping and travel. So the famous, I have my property at the beach that I rent, and I did 12 trips down there.
Yeah.
They don't want to allow for that.
They take out all the administrative and travel.
Right. So that's why a lot of times that, when we're advising, it's like we're giving.
But the leasing aspect, screening of tenants, showing the property,
inspections.
How about, if you're in a continual acquisition mode, if you're going out when you're evaluating new properties, is that considered it?
I think so. I think you do have to be careful when you look at the hours. Like, we're very aware of the time and the different activities there are. So like, for example, if that was a small percentage of my log and I was defending, or I say defending, that sounds very, if I was arguing a taxpayer's position, as long as I didn't think that was overly extensive.
Right. They had 499 hours of property acquisition.
Right. I would say, hey, obviously
3 to 5 hours here and there.
Right. I'd say, obviously, you're not going to do every deal. There's going to be due diligence done on deals that never get consummated. So I think you have to have that as part of it. But we do look at that because, a lot of times logs will come back and we don't typically see logs. We advise that they have them. However, the ones that we happen to see, a lot of times we will have discussions about, which hours we need to kind of focus on, just like we were talking about.
Yeah. And going back to, the benefits of this, I think a lot of agents and investors were mainly always focused on going and making more money versus maximizing the income that we net, which ultimately is, how much do you bring in, how much are your expenses, and what's your taxable,
Well, that's the thing too with investing in general, and even just work in general. It's like, if you want to work 2,080 hours or 2,800 hours and you want to show and sell 1,000 houses, it's like, okay, all that's requiring you to perform that work. So you work harder, you work more, you can make more. However, it's the worst type of income you can have because it's earned income. It's subject to self-employment tax. And even if you were a W-2 employee, it's still employment taxes.
Yeah,
it's the worst one you can get. And the whole thing about investing is it is giving you an avenue to make money or even build equity without the effort. And the more you build equity, some of the things you do now aren't because you're trying to generate an extra $200-$300 a month.
No.
You're trying to build equity down the road because what you're trying to do is build assets. So when you don't want to be working as hard on the earned income, you have assets that are either now cash flowing or have appreciated to the point of now you can sell them. And if you're not working and you're selling assets, well, maybe you're in a lower tax bracket. Maybe it's now more favorable. So those are things that, not as on everybody's mind today, but it's important things to kind of think about as people try to do, what their planning is. And it's never too early to plan. Like, so for example, my kids are 18 and 15, and some of the things I know now, I wish I knew at 22. And one of my things is, I want to start teaching them some of what I've learned from clients that are investors, things I've done myself, and just try to get them to understand, like, I get it, not everybody can be self-employed and not everybody can do that. But, as you earn money, think about how you're investing in and what you're investing in and how to diversify. And one of the reasons I love real estate is because, it's one of those assets that when someone's market adverse, and it cycles just like anything else, but you can see over time what the benefits of investing in real estate are.
Yeah, absolutely. So going back to, leaving principles and helping set your kids up for a financial independence in the future, what would you say, like, because you work with some pretty heavy hitter real estate, investors, what would you say are like the top 3 things that you would want to make sure that you drill into your kids' minds, that it's like, do this, do this, do this, you'll be set? Well,
I think part of it is, the first thing is having a savings plan. So you always have to be aware of what those opportunities are. So like, for example, when someone has a W-2 job, they need to know what they need to put in because the company might match a certain percent. If you don't put that money in and they don't match it, it's like gone.
It's free money.
It's free money. So you need to know some of those things. You also need to know how I should be investing it. So when I use the term 401k, everybody probably knows that. If I say regular or Roth, some people know that and some don't. And sometimes, everybody wants to pay less taxes, but when you're younger, you're not making as much money, you're in a lower bracket, they should be thinking Roth exclusively. They should just be thinking about that.
Thinking thinking long-term what you're going to invest in.
Right. Long-term what you're going to invest in, because I get it. Like right now, you start investing in a Roth today and it's 6,000 or 7,000, whatever the limit is. I get that. That's not super exciting, but you do that for a couple years, and then maybe you are able to get into a self-directed syndication or investment or private lending with your Roth dollars. And now it's becoming more and more powerful where, the norm is, okay, I'm going to have a Roth IRA. It's going to be in a bank CD or it's going to be in the market exclusively. But I mean, some of these investments, as you know and see, it's like some of these things have very high yields to it.
Yeah, massive growth opportunities.
Yeah, it's almost like sometimes with the market, you're kind of capped. I mean, if you look at the market over time, has its ups and downs, and it has a steady percentage. But with real estate, I'm not saying every deal is going to be a winner, but you have better potential to do greater returns in real estate.
Yep. Yeah, that's great advice. And for anyone listening that doesn't know what a Roth or a traditional one of the qualified plans, but big picture, you're paying taxes on the seed, not the crop.
Right.
Versus, with a Roth, you're paying taxes. You're investing after tax dollars into a Roth.
Right.
But as it grows, when you pull it out, it's not taxed.
Right. And then again, they change the law, sure.
Versus taking the tax deduction now on a qualified plan and then letting your account grow really big.
Tax deferred.
But then when
not tax free.
Tax deferred. But then when you start pulling it out, when you take distributions, they're going to be taxed.
Right.
And you don't really know what they're going to be taxed at.
You don't know what they're going to be taxed at. Could you have other income? And the other thing when you were talking about Roth is, if somebody's like, well, I've already put my money into the regular, well, you can do Roth conversions. Now, I'm not saying they're for everybody, but if I was a real estate professional and I had $75,000 in losses and I converted $75,000, I basically would pay no tax on it.
That's a pretty smart strategy right there, right?
Yeah, I got to think like that. And a lot of these things, you got to know what strategies you have to do within the calendar year and which ones you can do after the calendar year. So that's kind of important too, because if I see you had a $75,000 loss and I said in February or March, it's like, oh, I wish I knew, I would have suggested this. It's like, well, can't we just go back and do that? And it's like, this thing you can't.
No,
it's got to be done in before that calendar year. Yeah. So
that's great. So what are some other, options? I know you mentioned investing in syndication, a fund, or, where do you recommend people when they say want to invest in real estate?
Well, I think the issue that probably most people have, and it's a goal for them to get to, is accredited investor. So accredited investor, $1 million in net worth, excluding your home, or you make 300,000 joint or 200,000 as an individual. I don't know if they change that or, those things could always change. But so sometimes people get frustrated or discouraged because it's like, well, I'm not an accredited individual and I can't do that. And, all the good opportunities are for accredited individuals. And I would say to that is, well, that I don't disagree with that, but maybe look at your situation and figure out, hey, where am I at? Like, how close am I to being accredited? And, maybe there's steps that I can take on here. And so, those other, if you're not accredited, yes, there's other opportunities. There's opportunities for other accredited investors. So like, for example, you don't have to be an accredited investor to buy a multifamily or a single family unit. Right. Anybody can do it.
Yep.
But not everybody knows how to do it. Like they just think, I'm just going to look, I'm going to buy the property and, this is what my payment is. But a lot of times anybody that comes to me, and I did have an example of a childhood friend that came to me, we grew up together, and he says, hey, you know what, I want to get into real estate. And he was kind of doing his own thing. And I just kind of directed him to somebody that I knew that does mentoring. A lot of real estate people do get into mentoring because it's a valuable service. And after he was mentored, I think he had a whole different approach to it. So like within 1 year, he's got 5 properties.
Wow.
And it's like, and now it's like,
it's a game changer, right?
It's a game changer. And he kind of now understands exactly what the deal is. And, the funny thing is we just did our first deal together, him and I, because, he just wanted a partner on a certain deal. And, it's those opportunities are there no matter what, no matter what your status is. Anybody can do them.
Yeah, that's really awesome.
And anybody can private lend, by the way. I mean, as long as you have a self-directed IRA, you can private lend. So you don't need to be accredited. And private lending, everybody's looking for
capital.
Capital.
Yep.
I mean, everybody's looking for it. And there's more available than you would think.
And it's a great way to passively invest. It's much more passive than holding a rental property.
Sure. Yeah, it's a much easier. If you said to me, hey, would I rather be owning sticks and bricks or private lending? I'd say, hey, for me, private lending would be,
Now, with private lending, there's no real tax advantages for that specific strategy.
No,
unless it's in a self-directed.
Well, I mean, that's what I like about it.
Right?
If it's in a Roth account and it's in a Roth IRA, then that income never gets taxed. So, I mean, that's the perfect scenario. I'm not saying you can't do it in a regular IRA, but in times like this, when you're uncertain about the market and, you could be looking at, experienced money lenders. I mean, currently, I don't know if it's 10, 12, 15%, some points.
Yeah, I would say it's at least, 12 and 2.
Right. So
at least.
Right. So it's like, and then you have extension fees, you have collateral going in. Most private lenders, I think, are 70% loan to value, if not lower.
Yeah, so you're getting a great return with a very passive strategy. Let's talk about like marrying the two of those together, buying bricks and sticks.
Right.
So you get the depreciation, the leverage aspect,
right?
Appreciation, because you're not getting appreciation on the notes,
right?
So you get all those benefits of buying, let's say a small apartment building, a small multi-unit or a single family. You get those tax advantages, potentially coupled with the real estate professional election to help offset your active income,
right?
And then while passively utilizing a qualified plan, potentially a Roth, to have passive income coming in that doesn't have the tax advantages, but because of the vehicle that you're doing it in, you are you're growing a Roth account that you won't have to pay taxes on when you take the distributions in the future. That, to me, that's kind of like you get the best of both worlds there.
I mean, in the single family world and the rental property, most people don't understand the whole concept of depreciation. I mean, it's basically a reduction of income, based off of the price of the house and the useful life and that. But so a lot of times what you're looking at there is cash flow. What is the property cash flowing? And it's like, everybody will have a different opinion, but if you have a property that's negative cash flow, we got to question if that investment's good. If you're jumping into deals, if you're jumping into deals that are already like a single family unit, if it's already cash flowing $200 to $400, you're like, well, hey, I'm building equity.
Yep.
Granted, maybe there's some types of units that don't have the ability to appreciate as much as others. And I understand that. You have areas and different things like that. And I think the other thing with investing that you kind of just made me think about is, you can invest anywhere. You don't have to be limited to like the neighborhood that you're in and the areas that might not be the best areas to invest in, whether it's high taxes, things like that. And you have to look at, these areas other than the places that you're familiar with, because there could be good opportunities, in other parts of the country, because lower taxes, job growth, other statistics that indicate that, housing is growing in certain markets.
And you might even, I don't know I know it's not a hot topic now because, but it was years ago, opportunity zones.
Right.
And there's still advantages, right?
Sure.
It's still in play.
That's still in play. There's still things in play. I mean, we don't see many like-kind exchanges anymore, but, like-kind exchange is still a good thing where if you're, just going to move property to property and you keep like-kind exchange it, you keep deferring tax. That's very powerful. You just have to I always advise, if you're going to like-kind something, do it because you want the property, not because you want to say you had a like-kind exchange. Because what if you have an empty property for 6 months?
Make sure the deal still makes sense.
The deal always has to make sense. I mean, and I think that's where newbies probably don't understand, or they jump into things because it's like, hey, listen, if the deal doesn't make sense, walk away.
Yeah. So what I'm hearing is it's like, if you have a good deal and you have a good strategy, almost that goes for a great investment.
Right.
Combining the two, you
right.
know, and if you have a so-so deal and a good strategy, it may not even be worth it.
Right. Like, yeah, I mean, you can't just do a deal because you're thinking that it's going to appreciate. Like, things have to work in the deal. Your finance, we just talked about private money. I mean, all that has to work in the deal, you know, and, you know, if you're like another strategy that some people aren't doing is, you know, using the home equity in their home to do some of these deals, because, you know, you're using an asset that otherwise you're just kind of sitting there. Now, if you were using that asset to keep paying down credit card debt, building it up, paying it down, well, then, yeah, you're just treating it as, you know, a line of credit or like a bank. But if you're using that to get into investments, and, you know, what you're doing is you're kind of leveraging, you know, other assets to increase your net worth, increase the assets that you have. And I get it. Interest rates are high. Nobody wants to do it. You know, some people will just have the opinion that interest rates are probably where they should be. You know, and the other thing is, most people have been like, don't let the interest rates affect the deal. It is what it is.
Yeah, as long as you can still have the asset pay for the debt,
right?
And it covers it, and, you know, you have some level of cash flow. So you're saying, like, utilize a home equity line of credit to, you know, redeploy that capital into an investment.
Yeah, if you wanted to do an investment, and again, the numbers have to make sense, and you have to.
Sure.
But sometimes you don't want to have all your capital. For example, if you're buying, you know, single family units, it's not like you always want to, you know, get, you know, a regular conventional mortgage on that. Like, sometimes, I think once you have 4 properties, sometimes they look at that as more of a, hey, we'll lend on the portfolio, and we'll do things like that. So you gotta think ahead.
Use some commercial financing, you know, use the equity in your home as a down payment, and then utilize you know, buying in an LLC with some commercial lending. We have options for things like that. But with going into that, you know, one thing that, you know, I would like to ask you what your thoughts are, but a lot of people get stuck just on like, oh, well, okay, let's say it just breaks even.
Right.
You know, you borrowed money out of your line of credit. So by the time you pay the interest on the line of credit, you know, and then the new loan.
Right.
But let's say you get a deed in your name and it just breaks even. But let's say you're chipping away equity.
Right. Let's
say it is in an area that's most likely going to appreciate a little bit.
Right.
Let's say you get the tax benefits from the depreciation.
Right.
You know, and essentially, let's say you didn't use any of your own money because you used the line of credit from the bank.
Right.
So it didn't come out of pocket, let's say.
Right. Yeah, sure.
But let's say it breaks even at the beginning, but, you know, you believe there's rental increases over time.
Sure. Which is an area that you see, you guys probably see it on the transactional side, where properties are for sale and they're multifamilies, and they're asking a certain price for it, and then you ask about what the rental income is, and the most common response seems to be, well, they're below market value, but you can increase them. It's like, well, wait a minute, I'm only going to pay for what the value is if I increase them. But again, that's kind of a little bit outside of what you were asking, but it just brought that to mind. Like,
absolutely.
You can always do rent increases.
You do have
most rents are low.
You got to be very careful on that speculation, because there might not be the same rent growth that we've seen the last few years. I mean, it's been crazy, the rent growth. With that said, I guess the point that I'm trying to nail home and see what your thoughts are on it is, a lot of people get stuck on just like the face value of the deal versus looking at it, all those other benefits. Like, did you factor in the depreciation? Right. Because if it's offsetting your taxes, especially if you're a real estate professional, what does that look like? Right. You know, did you make an extra $5,000 a year in tax deductions?
Right. Because there's a difference between cash flow and taxable income.
Sure. So, you know, that's where I think a lot of people have to look at, you know, what's your goals? Do you need that immediate cash flow?
Right.
Or what would your finances look like 10 years from now had you bought an additional property per year?
A lot of times there's like tables that I've seen people, you know, use, where it'll show you, you know, obviously you're doing assumptions, but you're assuming the value going up and you're showing the debt going down, so you can see the equity that you're creating.
Correct. Yep. Yeah, that's what I look at. I look at it in totality, and usually 9 times out of 10, if the property breaks even or cash flows a little bit in a 2 to 3 year period, that so-so or good investment starts to look like much better.
Right.
As long as it doesn't have too many repairs and CapEx and vacancy.
Those are the things.
There's a lot of factors.
Right. Those are the things that probably scare newbies the most is, repairs and things like that, where more seasoned investors are probably more like, hey, I want to get in, do the rehab work, and then go get the refinancing when the property is going to appraise for more, where I think sometimes newbies are a little bit more scared of that and they're more turnkey. They want to be more just, hey, I walk in, I start collecting rent, and I don't have to worry about too many potential problems, in the first couple years.
Yeah. Yep. So we talked about buying rentals, lending, different, vehicles to do that in to reduce taxes. How about, you mentioned syndications,
right?
Investing in syndications. Are there some tax benefits? Could there potentially be? And then investing in a fund?
Yeah. With syndications, it depends, but I can tell you that sometimes with syndications, you can get depreciation benefits. So sometimes you do have that where you're investing in the syndication because there could be a bonus depreciation. There could be, a lot of times I'll say to a client that says, I'm thinking about investing in the syndication, and they're telling me about the first year. And I'll say, well, tell me what's the approximate depreciation write-off in the first year. So then I can start seeing like, oh, you invested $100,000. We're going to be able to write off $70,000 of loss in the first year. Like I can see where that benefit helps them. But not all syndications are about that. Some of them just become about, hey, am I just getting a fixed rate of return?
Sure.
Am I getting a fixed rate of return plus a share in the profits? And a lot of times you look at the syndicator themselves, because you want to know that, not everything you see on LinkedIn you're going to do the syndication for, but the one that I did, it was kind of funny because I had clients that were getting these K1s from this certain syndicator, and I saw what they were doing. And when the next deal came up, I said, I want in, so
you got to see it firsthand on the tax side.
And of course, when I did that, the syndicator was very specific to me and said, look, not every deal is the same, this and that. And I was like, well, I understand, but I've seen what I've seen. And so you don't always get into it because of for me, it had no benefit because it wasn't a big write-off. There wasn't a whole depreciation thing. I was just looking at the return. Rate of return.
Okay.
And the exit strategy.
How about in a fund? Is there do you see any funds that offer any tax strategies or tax benefits, I should say?
Typically it's the cost seg depreciation. That's really what it is.
So similar to a syndication.
Yeah. That's really what you're looking for that fund investment is you're looking for that write-off. Another example, it's not real estate, but the whole ATM machine investments, again, it's the same similar thing that you're looking for the bonus depreciation. And again, you're looking at what the cash flow is and what your rate of return is and all that. But most investors are like, what's the first year depreciation? Because they're looking worried about
the tax benefits.
Yeah, exactly.
So if anyone's listening, you're like completely overwhelmed. We were speaking in Greek. No, we appreciate your time. Hopefully there was some benefit to this. Chris, just to wrap up, any last words of wisdom for anyone looking to maximize their efficiency with their tax strategies?
Well, I think it's important that people work with a professional. And the reason I say that is there's a lot of professionals out there that, you have to watch what services they're offering. Some just want to do tax returns, but some want to look at the whole picture. And, when I go on social media, there's plenty of, there's plenty of people to work with. There's plenty of investors that need that guidance. You have to look at your situation as, hey, just like you do a doctor, or just like you do a lawyer, like, hey, I need to really, not just taxes,
specialize
right?
in
Not
this.
just taxes, but
you don't go to a foot doctor for brain surgery.
But what am I looking to do 5 years from now? What am I looking to do 10 years from now? Does this fit in those strategies? So
working with someone that really understands your business and your goals,
sort of saying, hey, you know what? I want to, I want to have quarterly consultations, or I want to do this. Where some people are like, well, I don't really need that. It's like, well, that's how just like, you get business coaching or you get things like that. It's like you got to look at the big picture and figure out what you want to do and where you want to go, and use the resources at your disposal to do that.
Yeah, I can. I'll definitely second all that information. So Chris, for anyone out there that might want to reach out to you to find out if they're a good fit for you or if you're a good fit for them, how would they get a hold of you?
The best way is probably, our website is dlcpatax.com. And on that website, you can hit the, submit a referral request. You could just call, 302-468-4380. And a lot of times what our team does is, we try to get an idea of what somebody wants, and then we set up an initial consultation. I'm just completely honest with people is, if we can help, we can. If I feel like, we can't, then I think it's important when you're in any type of business, just to be honest with people.
Yep. And what areas do you cover?
You mean geographically?
Yeah, in terms of returns. Like what states do you?
So the way business has worked now is we're working with people all over the place. So, we have clients in Florida, Georgia, California. It's just that's just the way the business has evolved some of it's COVID.
Yeah.
Everybody does Zoom.
Yep.
Nobody meets, but you're doing a lot of virtual things. So a lot of times it really doesn't matter where somebody is because that's not a requirement.
File returns in any
pretty
states.
Much anywhere. Now, if somebody called me and said, "Hey, I'm a Canadian citizen,"
right.
and then we kind of start to
start
to take pause and say, "I'm not sure we can do that."
Well, I can personally endorse Chris. I've worked with him for several years now, and appreciate everything you've done with me in terms of strategy. It's nice to be able to talk to someone that understands real estate, understands what the longer term goals are, and doesn't just give me a one size fits all solution.
Right, because it'll never be that way. Just because everybody, and that's what I like about the business is everybody's involved in something different.
Yep.
It's not one size fits all. It's not everybody's doing multifamily. It's everybody's finding different ways. And I find it just interesting when I hear about it because it's just something that I think has value. And I think more people should be looking at real estate as an investment.
Awesome. Well, thanks for being on today, Chris.
All right, thanks.
And thanks for listening. Thank you for tuning in to the Investor Agent Podcast today. We hope you found it valuable. Please tune in weekly at theinvestoragents.com.